Couple things once I get these slides to move. There we are. We want to talk about our objectives for this morning, but before we get to those, there's a new addition on each of your tables. It's this little tent with a Wi-Fi. I didn't know why we put it there because, as I said to Mary Lou, everybody in this entire room pays complete 100% attention to every presentation and would have no need to check email or do anything else. But in the unlikely event that somebody finds themselves in that position, there is information on each of the tables to help you in that regard. What we want to do, though, today, as we do each year with the A&A update, is to really focus on high-level changes, a 20,000-foot view, kind of the executive perspective, not the detailed granular perspective. We want to focus on private companies. We want to focus on things that are either just coming down the pike or newly applicable or might become applicable in the next year or so. Interestingly enough, the FASB was a little sleepier this last year than they typically have been, but that's okay. We've got some deferrals of lease pronouncements, and we've got some other things that allow us to continue to talk about those for a long time. There are a lot of things that we will avoid. We're going to avoid talking about IFRS. We're going to avoid talking about SEC matters. We're going to avoid several specialized industries like banking, certain communications, governmental entities, healthcare, and so forth. We'll touch just the corner of derivatives and hedging, and we really will not talk about auditing standards. We're talking about accounting standards rather than an audit process or SARS for the review and compilation standards. So with that perspective, I turn it over to Andy to kick us off with changes to US GAAP applicable now or soon.
Thank you, Jeff. So we'll jump right in to newly applicable standards with ASU 2016-01. It relates to topic 825, financial instruments. And the main provision of this ASU is that it requires investments to be measured, equity investments to be measured at fair value, with changes in fair value to be recognized in net income. So the way that this will be applied is with a cumulative effect adjustment to accumulated other comprehensive income as of the beginning of the fiscal year of adoption. It also simplifies the impairment assessment of equity investments without readily determinable fair values. And let me switch this slide. It also requires a qualitative assessment to identify impairment. If impairment is identified, then a quantitative assessment is also required as well. This also eliminates the requirement to disclose fair value of financial instruments measured at amortized cost for non-public entities, and requires separate presentation of financial assets and liabilities by measurement category and form of the financial asset. This ASU is effective for years beginning after December 15, 2017 for public companies and 2018 for private entities. Moving on, the ASU 2016-09 related to topic 718, stock compensation. This ASU simplifies several aspects of accounting for stock-based compensation. Those simplifications relate to the classification of these awards, the tax consequences related to the awards, and the presentation on the statement of cash flows. There are certain provisions that only apply for private companies. Those relate to policy elections, mostly to determine the term and the value of these awards. This ASU is effective for years beginning after December 15, 2016 for public entities and 2017 for private entities. Moving on, ASU 2017-09 related to the same topic. It specifies conditions requiring modification accounting on stock-based awards. Basically, what it does is it says that you don't have to apply modification accounting if the value of the award, the vesting conditions of the award, and the classification as either debt or equity do not change. If any of those three do change, there will need to be the application of modification accounting. That ASU is effective for years beginning after December 15, 2017. We'll pass it back over to Jeff.
So right after stock compensation, we get into tinkering with the statement of cash flows. Some of us are old enough to remember the issuance of FAS 95 way back in the like 1988-ish time period. And the 80s were a time, like with the 86 tax code, when they said, we're going to make a change and we'll never have to tinker with it again. And they believed that it was going to be the perfect cash flow pronouncement. Everyone would go with the direct method, and I think they were a little disappointed. But there have been some needs for clarification. So you're going to see a couple areas now of tinkering with the statement of cash flows. This first one's not all that bad. There's really kind of clarifying any debt repayments, early debt extinguishments as financing activities. I think most people would have deemed them to be that anyway. But there's really 8 categories in this particular ASU in the statement of cash flows. And in this regard, almost all of them make a lot of sense. They talk a lot about contingent consideration in business combinations because there was a great disparity in practice in that regard. And they got a little decision tree going there that goes something along these lines with regard to dealing with contingent consideration. Since the issuance of FAS 95, there have been a lot of changes in accounting for business combinations. And there's a need to estimate, as part of the initial purchase price, the contingent consideration. So then the question is, what do we do when we deal with that on the statement of cash flows? And they say, well, gee, if it happens soon after the transaction, it would be an investing activity, just like the original purchase of the entity. Now, but there's often a lot of other monies that happen in there. And we say, what do we do with those? Well, up to the point where you're dealing with the contingent liability, now this is after the transaction has happened, of course, the monies that you spend would be financing activities, and all the excess after that would be operating activities. I think there was a pretty lively debate. They had to pick a line somewhere, and that's where they chose it. Any number of spots probably would have been a reasonably logical outcome in that regard. Insurance proceeds from corporate-owned life insurance, the COLI proceeds, are deemed to be investing activities. It's a little bit morbid, but most corporate-owned life policies are, to some extent, an investment vehicle more than an operating vehicle. Insurance proceeds from different involuntary conversions are intended to match the nature of the loss. So if the building burns down and your insurance proceeds are covering the reconstruction of a building, that would be an investing activity. If your inventory burns and you're replacing the inventory, it would be an operating activity. So again, a lot of common sense, which is welcome and actually shortens our presentation a little bit. But the nature of the loss determines the treatment of the insurance coverage. There are several other considerations. One of the most noteworthy would be what to do with equity method investees who are distributing cash to their owners. There's actually a decision tree there that you walk down. A couple of if-then statements. It's pretty clear as to how to deal with those distributions based on the character and amount of each. This is applicable now. It's applicable for years beginning after 12, 15, 18 for private companies, which means for calendar year 2019, this will be applicable for your statement of cash flows. Many might have early adopted that if they had the particulars before. We're going to come back to a shorter one for cash flows shortly, but we're now going to talk a little bit about one that's been talked about for a handful of years, but really has become applicable depending on the entity for those nonprofits that had a 12/31/18 year end or a 6/30/19 year end. So those here that are in the nonprofit arena, this will be, for those folks, this will be old news. So this discussion is more aimed to help the rest of us who will be reading those statements as they're now coming out, and they might look different in several ways. And they really just tightened up the presentation with regard to restricted net assets. Instead of having 3 areas of temporarily restricted, permanently restricted, and unrestricted, you now basically have 2. You have assets without donor restrictions and assets with donor restrictions. Now, they still have enhanced disclosures that actually show whether those restricted assets are restricted for time. So we've granted you this money for 2020 operations, or for purpose. We've granted you this money to build a new building, or in perpetuity. We've granted you this $1 million, and you can then use the earnings on that for some other purpose. So all those disclosures are still there. In fact, they've become a little more clear in most regards, so that tends to be a very, very good thing. We also have a little bit more focus on liquidity and really a focus on how to deal with underwater endowment funds. There was a big concern that a lot of nonprofits were essentially borrowing from restricted monies to fund losses, to fund operating losses. Well, that probably was not a majority of them. That's a pretty grievous approach. So I think the FASB very appropriately wanted to shine a spotlight on that. So there's particular disclosures when you have underwater endowment funds, and there's also very particular disclosures with regard to liquidity. There's actually a footnote that discloses availability of financial funds for the following year. There's been a little disparity in practice as to how that's actually executed, and in fact they eased that a little bit to kind of give the benefit of the doubt to the nonprofit with the ability to have availability of funds. But nevertheless, it is a new look and new information. For those that were voluntary health and welfare organizations, there was always the need to have a statement of functional expenses, but now statement of functional expenses is required by all nonprofits, whether it makes sense or not. You could be a $500 million foundation, but you still need to have a statement of functional expenses now. That's okay, they're not very hard. There have been some enhanced disclosures with regard to how the organization is, their cost allocation plan. The enhanced disclosures tend not to be that tedious. They tend to still fit within an inch or two on a printed financial statement, but they can be highly informative. So I think the frustration level that many were expecting in that regard was a little less than maybe was feared, but we are finding that many of the readers are still getting used to that situation. Interestingly enough, board-designated assets remain unrestricted, but there's now a disclosure that requires the organization to indicate the amount and the purpose for which they are to be used. We have several other things that you want to be thinking about for this, and there are some points of flexibility as we move nonprofits and for-profits a little bit more together in how they report. Nonprofits have always had the opportunity to segregate operating activities and non-operating activities on their statement of activities. Very few do it. But now there's some additional guidance for some rules that whenever they choose to do that, it gives them some guidance, which I think embedded in that is the opportunity to maybe take more advantage of that if you're a nonprofit that really does have significant financial activities that are non-operating, if you will. And kind of small but interesting investment performance is reported net of investment fees, and the investment fees are, of course, then disclosed. So already applicable, but something to bear in mind as you're reading the statements. Oh, got one behind on that. So how about income taxes, the infamous deferred tax presentation that maybe more people should understand? I just read a story yesterday in the Wall Street Journal about Mattel got in a little bit of trouble with a little bit of untimely tinkering with their valuation allowance and their deferred tax assets. So in that case, they are asserting it was an honest error. It is a complex area. But this really brings a little bit of clarification to what was an area of uncertainty. And that means intra-entity transfers of assets other than inventory. Inventory stays with the old rules where the deferred tax effects of inventory still don't become affected until it's sold to an outside party. Remember the old basic intercompany profits and inventory rules, they still apply. But for other assets, fixed assets, IP, other things along those lines, you now actually have a different approach to it. Instead of waiting till it's sold to an outside party, they're now essentially the deferred tax assets are recognized when they're in fact transferred. That is effective for 2019. Early adoption was permitted if you had done it last year. Quickly on the statement of cash flows, this is our smaller one. And this is pretty straightforward as well, saying what to do with restricted cash. Well, that's a pretty short answer from the FASB. Restricted cash is to be included with cash and cash equivalents. Okay? A lot of people did that anyway, but now it's very, very clear. I'm pretty excited about the next one. There's a couple in here that I'm actually excited about, which I guess says more about me than it does about the FASB. But this one with business combinations I think is excellent. There has been, as our profession tends to do for many things, we are a profession of overreactors. It's good that we tend to be cautious and conservative. That's really what we're supposed to be about. But then we over-apply new rules too often. And they noticed that there was a gross over-application of the business combination guidance. Too many things were deemed to be business purchases as opposed to just purchases of a set of assets. So they clarified the rules with the goal of dramatically reducing the times when purchase accounting is applied. And they've defined a business, defined what would differentiate acquiring a business from acquiring a set of assets. And they have three basic indicators. If there is a process and it has economic inputs and economic outputs, well, then it might be a business. If it has a beak and web feet and feathers and is quacking, well, it might be a duck. So these are very, very clear indicators that when you look through the ASU, they're outlined a little more thoroughly than now. Now, what would not be that? Well, think of things like if you are a Coca-Cola bottler or a large-scale beer distributor, or if you have FCC licenses. Franchise rights, FCC licenses, licenses for intellectual property, they tend to be sets of assets. Those sets of assets, buying those sets of assets do not constitute a business combination and will be accounted for just as you would for buying any other set of assets. You don't have to value intangible assets and so forth, even though some of those are in fact intangible. And it becomes much more simplified and much more clear to most users of those financial statements. With regard to this information, the organization is still required to disclose the terms, of course, of the purchase of its material. And to the extent that there are incidental pieces that might be indicative of a business, remember, we still have materiality. If Andy's buying, I don't know, who knows if there is such a thing, but if there was still, if Andy bought the rights to the former Gymboree name and with that became a $100,000 building with his $10,000 purchase of the franchise name, he can dismiss the building. It doesn't change the nature of everything else. If it came with some other little goods and services, you still get to take the focus on the overarching economics of it. Now, with that, we'll back to Andy to talk a little bit about goodwill.
Yeah, so ASU 2017-04 relates to goodwill and other intangible assets. It eliminates step two of the impairment test, which was calculating the implied fair value of goodwill and comparing it to the carrying value. Instead, now you'll be able to compare fair value and carrying values at a reporting unit level. To the extent that carrying value is greater than fair value, an impairment change needs to be recorded. This also eliminates a requirement for entities with 0 or less than 0 goodwill in their reporting unit to perform a qualitative assessment. They still can, but it's no longer required. It doesn't want to move. There it is. All right, 2018-02 related to comprehensive income. This was issued in response to the Tax Cuts and Jobs Act in late 2017. Addresses issues raised by the stakeholders related to the deferred tax impact of the tax rate change on deferred taxes originally recorded to OCI. It enables entities to reclass from accumulated other comprehensive income to retained earnings for the stranded tax effect from the Tax Act. That's effective this year, in the 2019 fiscal year, but early adoption was permitted. 2018-08, not-for-profit entities. This ASU was issued in response and in conjunction with the Revenue Recognition Standard, 2014-09. It clarifies the scope and accounting for contributions received and made for not-for-profit entities. It assists not-for-profit entities in evaluating whether or not a transaction should be a contribution or a non-reciprocal transaction or an exchange transaction. Those will now be governed by the two different topics, 958 for not-for-profit organizations, if it is a contribution, or 606 if it's an exchange transaction. And it also assists not-for-profit entities in determining whether or not a contribution is conditional. It's going to be applied on a modified prospective basis, but a retrospective application is permitted. And the application timing actually depends on the effective date of agreements. It depends whether or not you are the recipient or the provider. It's effective for the recipient for years after 12/15/2018, and the provider in years after 12/15/2019. Another ASU-related not-for-profit entities, 2019-06. This ASU extends the private company accounting alternatives for goodwill and certain identifiable intangible assets to not-for-profit entities. This ASU does not change any of the alternatives, but rather just aligns the alternatives for private entities to nonprofits. The stakeholders, when they were looking at this, not-for-profit stakeholders argued that the impairment tests are not worth the costs that are going to be associated with it. And that way, this can be applied immediately with a one-time election, and not-for-profit entities can choose to amortize their goodwill or other intangible assets either prospectively or, prospectively with intangible assets that are already on the books and new intangible assets that are acquired in a business combination. And with that, we'll move into recent changes to US GAAP. There we go. The first, well, went too fast, 2017-12, topic 815, derivatives and hedging. This improves the transparency and understandability of an entity's risk management. It also aligns financial reporting with an entity's risk management activities. It reduces the complexity and simplifies the application of hedge accounting. And it's effective for years beginning after December 15th, 2019 for private entities. ASU 2018-07, again, topic 718 for stock compensation. This makes some changes to the accounting for share-based payments to non-employees, mostly related to measurement and the measurement date, as well as the performance conditions of the award. There are specific items that apply only to non-public entities, mostly related to calculating the value and the intrinsic value of the award. This is effective for years beginning after December 15th, 2018 for public entities and 2019 for private entities. (2018-13), topic 820, fair value measurement. This streamlines and simplifies the fair value disclosures for level 3 investments and eliminates a requirement to disclose transfers between level 1 and level 2. Instead of having to perform a reconciliation of opening and closing balances for level 3 investments, now we just need to report on the activity, but we do need to disclose transfers into and out of level 3 investments. There's also a change in disclosure for certain investments, certain entities that calculate net asset value. This is effective for fiscal years beginning after December 15, 2019, and early adoption is permitted. 2018-14, topic 715, defined benefit retirement plan disclosures. This reduces the necessary disclosures for entities that sponsor defined benefit plans. It also clarifies disclosure requirements for both projected and accumulated benefit obligations, and adds the requirement for an explanation of significant gains and losses year over year. This is effective for fiscal years beginning after December 15th, 2020 for public entities and 2021 for private entities. Early adoption is permitted. I'll pass it back to Jeff.
This is not the exciting one I previewed a few minutes ago, but this is a very helpful ASU with regard to internal use software, and particularly cloud software. A lot of people said, what do we do when we're essentially getting a cloud-based solution, whether it's a Salesforce or a NetSuite or anybody else along those lines? How do we deal with that? Of course, most private companies said, how do we deal with it without impacting EBITDA? But there are still some rules that should be had. I think very, very helpfully, the FASB decided to say, gee, these rules should conform to software where you actually own the license. There are separate rules where you're the seller or the provider. This is when you're the implementer, the buyer. And the long and short of it is that you behave in a very simple, in a very similar fashion to as if you bought the license and it was an on-premises application. That is that you capitalize all of the software design and implementation assistance, and you amortize it over appropriate life, evaluate for impairment, of course. something that's a little bit interesting to a lot of folks, but it has been the rules for a long, long time. You expense training, most people get that. You expense support, most people get that. But you also expense data migration, which is a sticking point for a lot of folks and where there was a disparity in practice. Data migration is actually typically not deemed to be part of the capitalized implementation, whether it's for a traditional type or a cloud-based program. This isn't applicable for private companies until 2020, really, or 2021 at the latest. But I would encourage using the guidance on an earlier basis if it makes sense, because it would be awkward to go against this guidance at this particular point. Andy talked a little bit about derivatives and hedging, and I don't know if you remember, but he mentioned that they allowed you to use more rates for your benchmark. Now, they actually enhanced that a step further because they listed a number of rates, and of course, if something was missing from a list, the presumption is you're not allowed to use something that's missing when they have an explicit list. They said, well, gee, we really should throw another one in there, and they did, and that permits the use of an overnight index swap that's based on a secured overnight financing rate to be one of the benchmark rates. And it is applicable for public companies already for 2019, and for private companies for 2020, calendar 2020. This is the exciting one, consolidation. So maybe, I can't remember, the years blend together. 10 or 15 years ago, they came out with this pronouncement for variable interest entities, kind of in the whole post-Enron thing. And there was a sweeping effort to consolidate everything. Some would argue that if you merely thought about another entity, you should consider consolidating it. But it caused a rash of evaluations. They allowed folks to come in and out of VIE status. There were many improvements to it. But similar to that business combination thing, I think they recognized that in the private arena, there was an overreaction to this and an overabundance of consolidation of VIEs beyond the point where it was helpful to the user. Because remember, there are related party disclosures already there. This is a private company alternative. And I do think why I'm so excited about this is that the formation of the Private Company Council several years ago was really one of the best things our profession did to help keep the usefulness of financial statements for private companies, because they really do differ. They really do differ from the perspective of public companies. And this is one of those key areas. And the neat thing here, and just by way of preview, early adoption is in fact permitted because it's not required until years beginning after 12, 15, 20, but it's exciting enough that it makes sense to do now. But a private company or reporting entity, and remember, a reporting entity doesn't have to be a company. One of the things I think is often forgotten is the issuer of the financial statements defines the reporting entity, essentially however you want, so long as in your first or second footnote you define what in fact that reporting entity is. So any private company or reporting entity may elect to not apply the VIE guidance with regard to consolidating legal entities under common control. Now, if you choose that, it's an all or nothing. You can't say, I'm going to consolidate these 3 because they look good, and I'm going to skip these other 4 because they don't. It's an all or nothing choice. You're either applying it or you're not. But that's still a huge option that wasn't there before. Now, what do you do with things like management fees and so on that would be eliminated in the consolidation? Especially in cases where, and in the appropriate application of the VIE rules, you could literally have an entity that was consolidated by 3 different investors. 3 different partial owners could trip the wires to trigger consolidation under the VIE rules. So you have one subsidiary that's consolidated into 3 separate parents, paying each of them management fees, of course, because that's what one pays to a parent company. And I think that what they said is, well, now what do we do with these management fees? And I guess out of politeness, they're calling them decision-making fees. Management fees are going to be considered on a proportional basis, consistent with percentage of ownership, not board seats, percentage of ownership. To the extent that they have other triggers for consolidation, you'll still honor the other triggers of consolidation. This only applies to those cases that would have been triggered under the VIE guidance, not under the overall guidance. So again, I think this is a great opportunity for many in the private arena who are a little frustrated by some of the VIE guidance. And oh, by the way, it also applies to the leased assets. Oftentimes you'll see an operating entity in leased buildings, and that had been loosened up a couple of years ago, but that continues to be further expanded. Can't see what slide we have up there? Good, I want collaborative arrangements. The collaborative arrangements are becoming more and more frequent between companies. And there's increasing clarification of how to deal with transactions between those entities. So if two entities are in a collaborative arrangement and one is selling something or shipping something to another one, is it revenue or isn't it? Well, now we have this clarification that says if that collaborator, the other party to your collaboration, was already or is otherwise a customer, then you apply the rules of Section 606, the revenue recognition rules, to determine how and if and when to recognize the revenue. If, however, you're not, if you don't meet that test, if you don't meet that and a couple of other tests, then you're not recognizing the revenue whenever you're transmitting it to a collaborative partner. We already talked a lot about nonprofit entities, but this one's kind of different. It's very important for a very small slice of those. And this has to do with the term collections. And this isn't in the credit risk thing. This is collections like art. Like I think there's probably a collection we should donate of past outlines to GYF CPE Day materials. But if that was such a thing, and if it did have value, and we did donate it to the Accounting Museum, which I'm not sure there is one, but there might be. The Accounting Museum, which also probably as folks on the staff have heard me tease before, is where you might find the Tick Mark Hall of Fame and good things like that. But if that Accounting Museum is housing these and we donate these to them, that museum doesn't recognize that collection or that work of art if it's intended to stay a collection or stay a work of art. And again, small slice of nonprofits, but for those for whom it's important, it's very, very important. Think museums, think of a lot of children's thing, think of all the Mr. Rogers stuff at Idlewild or at the Children's Museum. And there's usually an ongoing care and feeding of that, and sometimes a purchase and sale of certain items. So before they say, well, what do we do when we sell one? Well, it used to depend on whether you were going to then use the money from the proceeds to buy something else for the collection, and that kept you from recognizing it in revenue and recognizing it in the statements. But now they basically said you have a little bit more freedom. Proceeds from the sale, if they're going to be used for the direct care of the collection, expenses for maintaining the collection, can still be then kind of put in this non-recognition in the statement of activities, recognizing that sometimes to maintain a collection, an organization might need to sell some pieces out of it for more purposes than merely adding to the collection. Now, there still are several tests, of course, to whether the collection is going to be maintained and some definitions as to what defines ongoing care of the collection. But again, very, very important for, admittedly, a very small slice of those. But new and applicable starting in calendar 2020. So now, since we mentioned credit losses, we'll flip it back to Andy for credit losses.
ASU 2019-05 relates to topic 326 for credit losses. There is an ASU that was initially issued related to credit losses that's going to bring sweeping changes. That's 2016-13. The credit loss ASU was delayed recently, another year, from 2022 to 2023. But this ASU provides targeted transition relief for the implementation of this topic. It also allows entities to irrevocably elect a fair value option in topic 825 related to financial instruments to instruments that are within the scope of this credit loss topic. Like the financial instruments ASU we spoke about previously, this should be applied on a modified retrospective basis by means of a cumulative effect adjustment to the opening balance of retained earnings. With that, there are a couple new changes, one that's in effect now, and then one that Jeff mentioned was recently delayed, but doesn't make it any less important. We're going to cover in more detail leases and revenue recognition. So we'll start with leases.
So I get to cover leases, and Andy will cover revenue recognition. Again, since they've both been talked about before, we will take the high-level approach. It's interesting on leases, which in fact was deferred once again. It was to be applicable for years beginning after 12/15 2020, but now it's basically delayed until yet another year. And it's been 15 years since the first exposure draft came out, or almost 15 years, and it'll be at least that by the time it's applicable. So it's occurred to me that I've spent over 25% of my life talking about the lease exposure draft and new lease pronouncements in sessions such as this, and it's still not yet applicable. So with that in mind, it is likely to, in fact, happen. It was a little bit overdue because FAS 13, the existing guidance for leases, came out in 1976. And there's really been little change in that regard. And there was a lot of what's called off-balance sheet financing. And the primary goal of the new standard, primary goal was to eliminate off-balance sheet financing. And the secondary goal was to conform internationally and with fair value accounting. The second goal became more and more challenging for them. So they retreated to attacking the off-balance sheet financing. We're still going to have essentially the same thing we did before. Operating leases will still be called operating leases. Capital leases for lessees will just now be called financing leases. It's less impactful for lessors. We'll talk about them in a couple of minutes or two. But I think that the important thing to note is even though everyone was encouraged to read the financial statements from cover to cover, I think there was an awareness that folks often didn't look at the lease obligation footnote for operating leases and the future lease obligations. And this will take that away and put it on the balance sheet. As most know by now, it will result on an asset, a right-of-use asset, and an equal and offsetting obligation for those operating leases. Capital leases, now known as financing leases, will behave very, very, very similarly. So we do have very similar criteria. You might remember the criteria for capitalizing a lease. If there was a bargain purchase or transferred ownership, it would be a capital lease. The transfer is still applicable. There was another two rules under FAS 13 that if the present value of the payments at inception exceeded 90% of fair value at inception, or if the term exceeded 75% of the useful life, that would trigger capital treatment. Well, now they're taking both of those, and they're still kind of in the background. The spirit of the 75 and the 90% test are still there. And in fact, in some of the commentary, you're still encouraged to use those for perspective. But now they use the term substantially all. They leave the opportunity to have some judgment and disclose what that judgment is as to what is capitalized and what is not. What does it not apply to? Well, if they said it applies to everybody that has a lease contract, that's lease contracts in a conventional sense. It does not apply to intangible assets, biological assets. It doesn't apply to inventory. It doesn't apply to certain natural resources. They're all covered by other governance, and they'll continue to be so. For lessors, it's a little bit less impactful in the sense that I'm going to click forward a little quickly here if I get to the right spot. Well, I don't know where I am, so I'm sorry about that. The impact on lessors is much less. The lessors will actually lose one of their classifications, but it was a very infrequently used classification anyway, and that would be the leveraged leases. Lessors still have operating leases, picture real estate, office space, things like that, or equipment even. But on their capital lease perspective, they flip into one of two categories: the sales type leases and the direct financing leases. And the only real difference there, remember, is the sales type lease just dictates when to recognize the producer's profit or the seller's profit on that. There's some enhanced guidance for sale leaseback transactions. There's some enhanced guidance for related party leases as it continues to be adjusted by other things we talked about. And we still see that there's many, many, many more disclosures, both quantitative and qualitative, about management's significant judgments and assumptions in coming up with these. The takeaway is to remember that this will be more tedious to apply than conceptually difficult. Can't ignore it, because even though they keep deferring it, it will become applicable one of these days. It will be tedious. It will be important. It will be helpful to be in front of it and behind it. And it is helpful to have just like a capitalization policy of $5,000 for fixed assets, one can have the very same thing for leased assets. So at some point before applicability, it might be helpful to identify that policy. Now a little bit on revenue recognition, which is already applicable.
Yeah, the revenue recognition standard for non-public entities is applicable this year in 2019. Let me catch up. Sorry. Yeah, it was initially issued in 2014, ASU 2014-09. There have been a number of clarifications issued since then, including a delay of 1 year. And if you've come to our CPE days in the past, you've heard quite a bit about the revenue recognition standard. It was implemented by public entities during 2018, and when you're in the process of implementing this new standard, it's a good idea to take a look at public issuers to see how their disclosures have changed related to this ASU. Also, if not yet done, I know we're approaching the end of the year, it's a good time to begin to tackle those disclosure requirements, the new disclosure requirements, to ensure the collection of the appropriate information. There is a core principle of revenue recognition that I'm going to speak very briefly. It says an entity should recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration the entity expects to be entitled to receive in exchange for those goods or services. With that, it brings about a 5-step process to identify the contract with a customer, identify separate performance obligations, determine the transaction price, allocate the transaction price to those separate performance obligations, if there are some, and recognize revenue when or as the entity satisfies each performance obligation. There will be enhanced disclosures. This is kind of a quick version of the enhanced disclosures that are going to be required. We'll need to, for companies that will need to do this, there will be disaggregated revenue disclosures, both qualitative and quantitative. There's a reconciliation that's required of contract balances, both assets, liabilities, and receivables. We'll need to discuss the separate performance obligations, if there are some. And there will also be disclosures required for significant judgments, revenue recognition for performance obligations that are satisfied over time, and methods, inputs, and assumptions used to assess whether an estimate of variable consideration is constrained. And with that, there's 2 adoption methods that you can choose related to this new standard. You can use the full retrospective method, which will require you to restate all prior periods presented, or a modified retrospective method that requires you to restate only periods after the date of initial application. And with that, we'll move into a quick slide about potential changes to US GAAP.
So I think that the FASB, one more forward, FASB is always doing a lot of things. Maybe they didn't issue as much this year as they typically do, but they have a lot of things on their plate that really, as they typically do, deal with fair value, derivatives, hedging, business combinations. And I think one of the most urgent ones, and they actually, I think they just exposed it within the last month, is an exposure draft with regard to how to deal with the likely vanishing of LIBOR. So there'll be some guidance with regard to how to deal with contracts that are interest rate based or interest rate dependent, and LIBOR would be one of the components, as LIBOR is intended to be phased out in the relatively near future. And there'll be some very specific guidance as to how to deal with the impact of landing on whatever the replacement rate might be for each of the entities in question. So I think we can look forward to that one for next year. It's highly applicable, and I think we're ending just in time to invite Dawn Johnston and Mike Weber up to talk about interesting tax matters. So Mike and Dawn, thank you, everybody.